This conversation is with Anastassios Frangulidis, or Tasso as he's called by his friends. Tasso is a renowned economist here in Switzerland. He regularly appears on Swiss national TV and in Swiss media. For many years, Tasso was the chief economist and chief strategist for Zurich Kantonalbank, one of the largest state-backed banks here in Switzerland. Today, he heads up Swiss multi-asset Zurich of Pictet Asset Management. Pictet is a large private bank here in Switzerland that we at BFI have been working with for over 15 years. Obviously, with his background, Tasso has immense experience and knowledge in both economic research and investing. In this conversation, we touch on the current situation, the current context for investors, obviously touching on central bank policies, fiscal policies, inflation and interest rates, but also on geopolitics, which today have become much more important for investors to consider in their overall assessment of where to invest and where to allocate. When we had this discussion, it was right before the banking crisis started and before Credit Suisse had to be saved. Since then, the cracks in the system have become more and more important, and I doubt that this is over. At this point, it is extremely important that you consider risk management, international diversification, and downside protection. We'll certainly have some more conversations on that in the coming weeks, but for now, it's right before Easter as I tape this intro. I hope you find some time to spend with your loved ones over the next few days, and as always, if you enjoy these conversations, please be sure to subscribe or to follow. Happy Easter to all of you. Tasso, welcome to our offices, and thank you so much for taking the time to come here out of your busy schedule. I know you're very busy right now with everything that's going on. First, before we go into that, one thing, I'm calling you Tasso, that's your nickname. Your real name is Anastassios Frangulidis, which already gives a bit away where you are from originally. Tell us a bit about your background.
Frank, thank you for having me here. Indeed, I was born and I grew up in Thessaloniki, in Greece. That's the second largest city of Greece.
If you think back of your growing up there, I have to pull your leg a bit because you are Greek and you're an economist, and we're now kind of looking at another time where credit crunch is in the news. Were there phases there too when you grew up where Greece was in difficulties credit-wise, or was that a different phase back then?
No, that was a different time. When I grew up in Thessaloniki, especially around the end of the 70s, Greece had a very wealthy financial situation. The debt to GDP at the time was below 30%.
Really?
Yes.
Okay. That has changed a lot.
And that changed already in the 80s.
Okay.
And in the 80s, the government of PASOK at the time, with the Prime Minister Andreas Papandreou, decided to increase expenses. And then the debt went up from 30% end of the 70s to 90% end of the 80s.
Yeah. You then went to Switzerland to study economics. So you said that was at the beginning of the 80s when you came to Switzerland?
No, that was end of the 80s.
End of 80s?
And that was great at the time, because that was another way of thinking that I used to be in Greece, or used to have in Greece. That was this kind of monetarist thinking on the one side, but also this liberal thinking we have in the canton of Zurich.
When you say liberal, you mean classical liberal, or?
Yes.
Okay.
Yeah. But this classical liberalism has also the impact on how do you think in economic matters.
Right.
And that was a very great thing for me to discover this kind of thinking. And if you come from a country that has been governed for 8 years by a socialist government that was
Papandreou, which basically,
that changed. Huh?
So if you say you encountered monetarist theory, is that where you recently, when we talked, you mentioned Milton Friedman? So that's where you came across Friedman then? Or,
Yeah, indeed.
Okay.
That was the dominant theory at the time, because you know that was end of the 80s, start of the 90s. We had the experience of the inflation period in the US and also outside of the US in the 70s, in the 80s. And even in Switzerland, end of the 80s or starting the 90s, you had a high inflation rate. You may remember in 1991, I think, we had an inflation rate of around 6 to 7% in Switzerland at the time.
And the U.S. was even higher.
In the U.S. was higher. Yeah.
You've had a banking career all the way through, right?
Yes. It was already mid of the 90s as I started, working at the time for the UBS. Then I moved to ZKB, end of the 90s.
Zurich Kantonalbank.
Zurich Kantonalbank, yes. And then I stayed there for 17 years.
17 years?
17 years, yes. Before I moved to Pictet.
What was your role at ZKB?
For several years, I was the chief economist and also the chief strategist of the ZKB, and I was the responsible, or I was the head of the multi-asset research of the ZKB. That means for the economic part, the strategy, and also the building block part. That means the funds at the time that ZKB used for the mandates.
That was an interesting period. That was also a lot of responsibility. What made you actually leave ZKB? Because actually that's quite of a dream job to be the chief strategist and economist. What was your reason or choice to then go to Pictet?
I did this job for a long period of time, and I wanted to learn a little bit more about the institutional part of the business.
So today you advise institutional clients, so that's what kind of, so it's less economist, it's now actually also investing decisions.
More investor, I mean an investor more. And not an economist or not a person who has the responsibility for the research. So,
right. So you really have both sides of research, and that's why I'm so excited to speak with you. For those who watch, we work with Pictet. Obviously from the BFI side, we're a wealth management firm, and Pictet is one of our major partners when it comes to custody and trading. So in Switzerland, for those that don't know, there's always this triangle: the client, the bank, and then the independent asset manager, or Pictet itself, right? So that's where we encountered each other, and why it's so great to talk with you. You also, I remember you mentioning once that you actually were quite involved also in an association in Europe.
The chief economist part of the Association of the Public Banks.
Did you step out of that, or are you still a member of that?
No, I'm not a member.
No more.
Since I left the ZKB. It's based in Brussels, and the association has a lot of members from the different state members of the European Union and also other countries that work closely to the European Union.
So when did you start being in Brussels? Was that at the beginning of the 2000s?
Yes,
then?
It was around 2009 to 2010.
Oh, so you were there right after the financial crisis, actually.
Yes.
In your view, looking back at that phase, do you think Europe did a good job at managing that period?
Definitely not. Definitely not. It took too long to have a response, and markets were ahead of the people in charge. But that's a European phenomenon, because Europe is not a country as the US is. Europe, or the European Union, is a union of different state members, and they need time to take decisions. And this weakness was was concentrated on the fiscal side, less on the monetary side. In 2012, Mario Draghi was able to react by giving this famous speech.
Doing whatever it takes.
At the time, without having received any approval from any European politician. That's good. That's good. On the fiscal side, then you need to work closely together, and that's where the Europeans need more time to react.
And I think it's important also to mention that, when you say it was good, so there's obviously positives in decisiveness. However, there's also the negative side, or the drawback, that we've seen a lot of fiscal stimulus and a lot of monetary stimulus, which actually has created a lot of debt, and that debt obviously is not all good. So it's there's something to be said for more restraint in central banks and governments, actually. I mean, one of the concerns I have, and I actually think you have that as well, based on what we've discussed, is that maybe governments and central banks are also a bit too powerful or too active. If you compare the situation back during the European credit crisis and the situation today, once again, the Fed and central banks, and now Fiscal is very much at the core of the attention. We actually have a chart that you sent. I don't know if we want to have a look at that, but if you had to sum up the situation today and maybe also compare it a bit to 2008 and 2012, in a few words, what's the situation today and what's your outlook?
You mean regarding the fiscal policy and the
I
fiscal
guess.
stance?
Yeah, I mean, there's a lot of moving parts that we have to discuss, but from a monetary perspective and a fiscal perspective, one of the issues we have obviously is now inflation picking up, being much higher, interest rates being higher, and now suddenly the central bank has once more a difficult job, right?
No, indeed, that's a different environment than we used to have in the last 30 years. At least. We are talking about inflation. Inflation as a result of a strong demand we had in the last year. And also some restrictions on the supply side. But the strong demand in any case. And if you look back from the 80s or start of the 90s until 2020, that was a period of weak demand. That's why sometimes the fiscal policy was needed. In times where the demand from the private sector is very weak, we should have a support coming from the fiscal side. And that's exactly what Keynes said 70 or 80 years ago, and a lot of Europeans, and not only Europeans, politicians are referring to. Keynes said, okay, when you have a lack of demand from the private sector, you need the support of the governments. And the governments, they have to spend more, especially in education, in infrastructure, whatever. But as soon as the demand has returned, then the governments, they have to start saving. So that over the cycle, that you have a balanced fiscal situation. And many politicians have forgotten the second part of that.
That's where the modern monetary theory comes in today, right? Where debt no longer matters. And you actually mentioned, you said that Friedman is still alive, fortunately.
Yes. And that's what is proven now, exactly now. We had a period of time with a very strong support from the fiscal side especially during COVID, but also a very strong response provided by the central banks. And if you see the liquidity that has been provided to the market by the central banks worldwide, but also in the US, has exploded.
You actually in that one chart that we have, you called it a rampant stimuli.
Oh yes.
And I mean, what it shows there in that chart is, maybe you want to describe it, but plus 25%. I mean, that's within a very short time period.
Yes, what we do here, we compare the provision of money supply by the central bank, in that case by the Federal Reserve. We compare that with the nominal GDP. That means we see, and that's I think the blue line we have here. We see how much liquidity has been provided by the Fed that hasn't been needed by the real economy. And as you can see,
so an overproduction.
An overproduction of liquidity, yes, indeed. And as you can see, in 2020, we had a huge overproduction of liquidity, and you will see also the correlation of the blue line and the red line. The red line is the CPI, Consumer Price Index in the US, and as a result of this oversupply of liquidity, combined by the fiscal policy, we had these sorts of inflation. But also here you can see also that the Fed and also the other central banks have reverted this kind of policy. They reduce liquidity since longer, and that will help also to combat inflation and to fight inflation. And that's why I think we will see a decrease of inflation from a cyclical point of view, not from a structural point of view. From a structural point of view, probably we will have a higher inflation than we used to have in the last decades. But from a cyclical point of view,
it will come back a bit, is what you're saying.
Based on that policy of the central banks and the policy, the monetary policy in the US, but also in Europe and in other places is tight today, especially in the US. Based on that, we will see a decrease of inflation.
Just to be clear here on the chart, the blue line, we're talking about M2 compared to nominal GDP. Now, that is purely monetary policy we're looking at here, the 25%. The fiscal part is not in it, right?
No.
Okay, so we'll look at that
separately. But in combination with the fiscal...
It was even more.
Yeah. In combination with the fiscal policy, we had this impact on inflation.
If you look at this chart and, in your words, did they overreact? Was it too much? I mean, it seems like it was much more than GDP needed, right?
But yeah, from today's point of view, no question about, no doubt, they overreacted from today's point of view. Yeah. Now, when you go back to March 2020 or April 2020, at that time, the world was very unknown. That was a very unknown future we had at the time.
So maybe it would have been good to be a bit slower, like the European Union back then.
Yes. In that case, yes. Sometimes you should give yourself some time before you respond, but sometimes you have to respond even faster. But
more easily said than done. That's really what Friedman said, right? I mean, when you mentioned Milton Friedman, I think if I remember my theory back then, I mean, his point, one of the key points he made was that it's extremely complex and difficult to actually use monetary theory in practice because it's such a it's more of an art than a science, really.
Yeah, indeed. But Friedman was also the person who was supporting for having clear rules on the monetary policy by telling people already before what kind of growth of the supply side of the money supply should be expected. Indeed, the most famous sentence Milton Friedman uses that inflation is always a monetary phenomenon.
Was help me with that is the quantity theory of money, that simple formula of what is it, the MV, M times V is equal to P times Q. Was that Milton Friedman?
No.
Okay. That has proven correct. So the MMT crowd has been proven wrong to some degree, right?
At least now, it took.
They might come back.
It took more than 30 years time for people to realize that inflation can be a monetary phenomenon.
Right.
But as I said it before, you need to have also strong demand, really demand. And that was happened in the last years in the US, but also outside of the US.
I mean, the complexity, the problems that the central banks are, it's a real balancing act at this point. I mean, the central bank is in a situation where they want to bring back inflation, but they have, and that's why we think it's going to be sticky. To some degree, it's going to remain elevated. They're fighting against all other kinds of forces, right? Including, the fear of a recession, but there's also the supply chains. There's it's difficult with the debt, the fear of a credit crunch. There's lots of pockets of debt everywhere, real estate, etc. So
the target of the central banks is, especially if they want to fight inflation and they have to be more restrictive, the target is always to achieve the so-called soft landing. But in reality, it's extremely difficult to achieve that in times when you are more in the restrictive part of the monetary policy. Soft landing is the exception, not the policy.
There's so many factors and variables that are being influenced that it's difficult to deal with one tool.
And as you know, you have a lot of lags
Yeah.
on the impact of the monetary policy. You take the decision today, and you see the result 15, 18 months later.
We actually, in this next chart that you actually provided there, you see some of the impacts on housing, on orders, and so on.
Yeah.
And
I mean, that's the situation today. The Fed started with the increase of the rates already in March 2022, is more than 1 year ago. And you see already the impact on the housing market. The housing market in the US is today in a recession. Mm-hmm. You see also the impact on the orders. And here we use the ISM new orders to refer to that. And we know...
Can you explain ISM new orders, what that is?
A lot of people in different companies are asked about their expectations on their orders, and they tell their opinion and their reality. How do they see the situation on the order side? And if you summarize all this opinion, you have this kind
so
of
it's an index of demand in the US.
Yeah. And then you have also the evolution of the profits in the US, but also outside of the US is a similar picture. But also in the US, you see here that that earnings have been downgraded, and earnings expectations also since last July. It seems that we have a decrease of margins, and that's already a reality. And you see that, you have recession in the housing sector, a deterioration on the order side of the companies, a deterioration on the earnings side of the companies. The only one place where is still very strong is consumption and employment.
And we can see here. I mean, that's interesting. Why is employment? Why is the labor market still so tight? So that doesn't really react at this point to the drawback or the slowing of the economy.
The employment is always a lagging indicator, but based on the past, we know that it normally takes 12 to 15 months after the central bank starts hiking for the consumption to start decreasing in real terms. For the time being, we still have an increase of real consumption of above 2%. That means probably this time it will take longer for the consumption to slow down strongly. And that is a phenomenon that has also to do with two factors. The first one is the excess savings that the US citizens have.
And not just in the US, I think. I mean, during Corona, with all the fiscal stimulus.
Yeah, not only in the US, but especially in the US. Yeah. We had 2 times of large transfers of income from the government to the people. No? That one of the main reasons for having this excess savings in the US. And also during the COVID crisis, people weren't able to spend money. That's the other reason. That's the one. And the second one is you may have noticed that we have a very high number of job openings in the US. And that's because a lot of people left the labor market during the COVID crisis, and especially people with an age over 55. If you see the participation rate for the labor force with an age between 18 and 55, this participation rate has fully recovered after the drop during COVID. But for people over 55 years, the participation rate is still very, very low. That means probably we have lost 2 to 3 million people in that age. They would have worked otherwise.
And they don't show up in the unemployment statistic.
And they are not there now.
They left, yeah.
They left. And at the same time, because of COVID and because of the fact that borders were closed for a long period of time, we didn't have flows from people who immigrated to the US and also to Europe. And that means we have a labor force that is smaller than it used to be. That's a lack of supply of labor. And that's an important role because why the labor market is too tight. And probably it takes longer for the labor market to deteriorate, and it takes also longer for the consumption to deteriorate compared to the previous cycles, and that's why the recession, the very weak economic conditions that we are expecting to happen, and we think the US will be very close to a recession. That will take more time to evolve.
In this chart on page 6, you actually see a huge excess savings rate there in the US. And so basically that's now starting to go back, but there's still quite a bit of that will kind of keep things going for some time.
Yeah, indeed. You see that also here at the peak we had 2.4 trillion US dollar excess savings. And now we have 1 trillion less. That means already 30% to 35% has already been spent. And that's why consumption was so strong, even in the time when real disposable income decreased strongly. That's the other one chart we have here. We have seen a very strong decrease of real disposable income because of inflation, but people still spend a lot of money because they deploy their excess savings.
If we go to that chart prior, that's an interesting one, right, in that context as well. Number 5, the U.S. Conference Board leading economic index versus Fed easing.
Oh yes, you see that based on that indicator, we should have expected the Fed to have reacted. But that only if you take the last 30 years. But as we discussed before, in the last 30 years we had a lack of demand and low inflation. And now we have much higher inflation than we used to have in the last 30 years. That means we have inflation above 5%. So today's situation is more comparable to that we had seen in the 70s or in the 80s. And if you go back to the 70s and 80s, you see it here that the Fed used to react slower and later, like today. And that's because we have a different inflation environment than we used to have in the 90s or in the last 2 decades.
The big difference, I guess, here is that back during that period, we had a lot less debt.
Oh, yes. Yeah.
So it was less dangerous to increase. I mean, it did trigger a recession, a heavy recession in the US, but Paul Volcker's policies were not kind of in between that rock and a hard place of, on the one side, debt and the problem of the financial markets being extremely toppish, and on the other hand, inflation runaway. So he could kind of focus on that one side of the economy.
You are right. Paul Volcker's monetary policy was the most tight monetary policy we have seen in the modern.
How high were the interest rates back then? Was it the real interest rates were? The
nominal rates went to 19%, close to 20, right. And the real yields went up to 10%, more than 10%. Yeah. And that was the most tight policy we have seen in the modern policy, in the modern economic time after Second World War. I would say after this period of time, if you compare the time after Volcker, we have now the second most tight, or the second strongest response provided by the central banks since then. But back to the 80s, to the start of the 80s, the response provided by the Fed at the time created one of the most severe recessions of the last 70 years because of the very high real yields. But it was needed because at that time we may had a low debt level compared to income. But at that time, we had a very high inflation expectations by the consumers, by the market participants, and not only on the short term, but also on the long term. The market participants expected at that time, end of the 70s, inflation to stay at 10% or above 10% for 5, 7, 10 years. And this is not the case today.
What was the reason for that? I mean, one factor was Bretton Woods and the depreciation of the dollar. Were there other factors
The
there?
other fact was that during the 70s, especially after the first oil crisis, we had a long period of time with very low real yields or very negative real yields. That means the inflation problem wasn't responded at the time, and they left the problem growing at the time, and then at some time the Fed, and in that case Paula, had to react. And if you wait too long, and inflation's expectations are anchored and are established, then you have to go even higher in terms of real yields in order to fight inflation, because you have to change our expectations. It is difficult to change the minds of the people, especially if they have established the inflation expectations based on their experience over a long period of time. That's why you have to fight inflation as soon as inflation has appeared. And that's what the Fed is doing now, and that's a good policy.
Compared to back then, I think inflation expectations today are not that high.
No,
I think most people actually expect it to come back quite a bit.
Yeah.
We actually think it might be quite sticky, but it shouldn't go much higher.
Yeah, you can read the inflation expectations on the inflation swaps or in the inflation-linked bonds, and you see that the inflation expectations for 1 year at a high level are close to the level of today, a little bit lower. But if you go to 7 or 10 years, you see the inflation expectations are around 2.5%.
Yeah, that's where that inverted yield curve comes from. Yeah. That yield curve, that situation right now does speak for a recession, though.
Yeah, based on the experience we have, an inversion of the yield curve is a sign of a possible recession. Not in every inversion of the yield curve leaded to a recession, but every recession has been forecasted by the inversion. And now we have a very strong inversion. We haven't seen something like that since the 80s. Right. And I think we will have this kind of yield curve for some months, for the next months. And this is one of the worrisome signs that we may end up by having a recession.
One of the charts that we might look at briefly is the one where you show the the drawdown in the S&P 500, but then also it's number 4, but also the 10-year government bond drawdown, which is quite extreme. When I saw this, I hadn't seen that comparison so far.
Yeah, all of us we know what happened last year. All of us we have portfolios, and we know even if you have a well-diversified portfolio, last year you had a very negative performance.
Everything went down. Yeah.
Everything went down. Yeah. But what is different to the previous periods is that this time not only the equity market have corrected a lot, but compared to previous recessions, less than in previous phases. But especially now the fixed income market has shown a very strong correction, and that's because of the response of the monetary policy on the one hand, but at the same time because the starting point of the correction was a very difficult starting point. We didn't have any real coupon at the time.
Negative interest rates.
Yeah, negative interest rates. And if you have that, and then you have the move on the rates, that has a very negative impact on the performance side, and that's what happened not only in the US, but also in different European countries also. I would say worldwide, with exception of Japan and China.
In your view, I mean, one of the things that you notice is that in this kind of situation, bonds actually react much quicker than equity markets.
Yeah.
They tend to lag a bit.
Yeah.
So is there more to expect on the downside on equities?
There is some threat that we could expect a further correction, at least until the monetary policy is starting to change.
So everyone's hoping for that U-turn from the U-turn, right? but that's where it gets difficult because of inflation again, right? So it's
compared to the history, the Fed and the other central banks, they will have to wait a little bit longer. And that means also the response will be later than it used to be in the last 30 years. That means also we have to suffer a little bit longer.
Well, later I think you have that kind of, to sum things up, we have that chart showing the cycle, and part of that cycle is the southern or the 6 o'clock part is the contraction. I guess the question is, in your expectation, is this just another cycle, or is this a different kind of more secular event where the contraction could take longer and go deeper?
No, I would say this is the end of the current cycle, and an end that has been caused by the tight monetary policy. And then we will have a new cycle later. Right. But first of all, this cycle has to go to an end. And the target is to achieve a lower inflation rate so that we can start again by having lower nominal and real yields later on. But the interesting point is that aside from the cyclicality of the current situation, we have already a world that is working in a different way than it used to work. That means from a structural point of view, we have also there some changes.
That's a huge point, right? I mean, we're focused very much so far on on fiscal policies and monetary policy, but now really the topic of geopolitics has become much more important. And I guess what you're alluding to is also the rearrangement of supply chains and so on, which has a huge impact on inflation.
Indeed. There's the question of deglobalization, or the question of regional cooperation instead of globalization, which means also less efficiency for the global economy and less provision of goods worldwide, and also less productivity in that way. And aside from that is also the real question of the geopolitical situation and also the impact on the military side. We see that a lot of European governments have decided to speed up military programs, to increase their expenses for military goods. That's a different world than we used to have in the last decades, at least here in Europe. And also regarding our approach to powers, to regional powers across the world, there we have also some changes. We see that the regional powers like India, Pakistan, Saudi Arabia, Turkey, they try to follow their own policy, and they do not follow the policy of the West. And I think it's especially extremely interesting to see that that Iran and Saudi Arabia try to regain confidence to each other and to improve their relationship. And they have negotiations in China, in Peking.
Supported by the Chinese.
Supported by the Chinese government. That's a sign. And in the past, for the West, the oil sector and the energy sector was extremely important, and it was also important to have a direct access to the governments of countries that produce oil. It seems that we lose some access, and other powers are getting stronger.
I think that what's really important is for us in the West to also understand that the storyline that we hear in the media is maybe not the complete story. One example is the fact that most countries in the world are not supporting the sanctions against Russia. It's something we have to be aware of, because I think generally when we watch and read the news, we think the whole world is behind, our point of view, and that's not correct. So what you're saying is absolutely right. The world is changing, and there is a bit more of those two blocks. And the question is, who groups around the Chinese, who's going to group around the Americans, and there is quite a bit of shuffling and maneuvering around that topic.
Yeah, indeed. If you take the world map, you see the countries that are following the sanction policy towards to Russia. You will find the US and Canada. You will find the European governments, with some exceptions. It's Hungary or even Turkey. You will find Japan and Australia, and not much more. South Korea also. But the majority of the other countries do not follow the policy of the Western countries.
So we do have that battle between, ultimately it's really the US and China competing. One of the things that I wonder what your thoughts are on is the whole question about the BRICS currency. This whole idea of this new currency where now actually Iran and Saudi Arabia are discussing trading oil, not in dollars, but in different currencies. What's your view on all that?
That has been a target or aim of many countries already in the past, and probably also of China and Russia. But it's not so easy to replace the US dollar by any other currencies. I don't see that for the next decade. But we will see, in any case, efforts toward to this policy. But from today's point of view, I don't think that the US and the Western are so weak that we will discuss about a replacement of the US dollar as a reserve currency within the next years.
Now, when you say that, I would agree. I think, it's replacing the US dollar is not as easy as some people might talk about in certain articles and so on. I think it's a difficult game, and the US is certainly doing things to avert that danger. But as far as, kind of having it almost like a split world and where part of the world goes towards another currency and the West kind of sticks to the US, the Pax Americana type world. Can you envision that kind of situation?
Yeah, yes, I would say yes, that's a possible scenario that will start by having more regional cooperation instead of globalization. And if this regional cooperation is established and has always some strong history, then the next step could be to try to replace the main currency of the world. But it's not so easy as we say that today. And it will take, in any case, very, very long time. But we see first signs that this could happen later on.
There's certainly a strong will with those countries. I think what you see is in those countries that are not on our side, let's say, of the fence, you see a lot more anti-American speech and politics, and it seems to be building up, and there seems to be more of an alliance there than it used to be. At least that's what I seem to recognize in some of those maneuvers. Obviously the marriage or the partnership with some countries, for example, Russia and China, it's not that stable. It's a situation where currently it's very complementary. No. The Chinese need the resources and the Russians need the capital and the help with technology. So for now, it seems to be working, but I think it's more fragile than some people think it is.
No. And it would be also very interesting to know how the majority of the Russian population thinks about that. Do they feel more as European or as...
They feel more European. Yeah. It's a shame that this situation is here. If you look at the blocks, there's US, there's China, and then there's Europe in the middle. No. We're in a difficult spot at this point.
Europe is much weaker than it used to be 50 or 60 years ago. Also, from an economic point of view, it's okay. It's still a strong power, but from a military and political point of view, Europe is still weak. That's why Europe needs a stronger European Union. That's the reason for the existence of the European Union.
The question is, what would a stronger European Union look like in your view?
Yeah, I hope not a huge bureaucracy.
That's where we're going right now.
Yeah, that's indeed, and that's why it's a little bit pity that the UK has left the European Union, because we need to have this kind of voices within the European Union. Yeah.
It's a pity on the one hand. On the other hand, it could push actually for a more federalistic type of European Union. Only at this point, the trend seems to be very centralistic still.
Indeed. The European Union has provided us with a lot of advantages, like the peace for, say, 60, 70 years, and also the common market. That's the huge
that was a starting point,
which of the European Union. But yes, indeed, we have more bureaucracy. I would say we have a little bit more France and Germany in the European Union than UK or Scandinavian
we'll miss
way of thinking.
That's where we miss the Brits, right?
But also the European Union is a new experiment. It's an evolving situation. It may change.
Where do you think it will go? I mean, are you optimistic that they may change and actually be more of a, currently, I mean, it's really run very centralistically, but then it's these different countries and everyone has a different view. And what's your vision for Europe in that sense?
I think the so-called Europe of the regions, Europa der Regionen, that's a reality in Brussels. You have people presenting this kind of vision. It will be stronger in the future, but probably it will take.
Why will it be stronger in the future?
Because there are an increasing number of people within the different regions of the national states who want to have more responsibility.
Right.
If you live in Marseille, or you have to ask Paris. If you live in Alicante, you have to ask Madrid. If you live in Thessaloniki, you have to ask Athens. And there are local people who think, okay, give us a little bit more responsibility.
Right.
Because more responsibility means also better shape of the public finances.
It's closer to the problems. It also creates more competition, which is a huge element of free markets and efficiency. That's the danger.
We know that
that's
from
what we know in Switzerland, right?
We know that the competition between the cantons,
which they're trying to kill internationally, though.
Yes.
There's also that minimum tax international, the 15% tax minimum, and so on. Those ideas. That's where I'm saying I'm concerned, because those ideas go more and more towards collectivist and centralist type policies and thinking. So I'm wondering, why do you think it will go the other way?
But you see, this kind of ideas of more centralizing form of governance, they come after crisis. You have a crisis, you have a financial crisis, then you look for a solution, and you think it's easier to find a solution in that way, in the centralized way.
Yeah.
But let's hope that we won't have crisis every few years, and that people in the region they can convince the central governments of their rights within the region. I don't predict that it will happen within 1 decade or whatever, but I hope at least
during our lifetime.
We will see.
Yeah, I think I think what I also would hope for is that that politicians would more honestly and self-critically look at the effect of centralized policy. Because in fact, I think even in a crisis, a decentral approach to decision making and giving more decentralized decision making power can be a huge benefit. Obviously, during the pandemic, it's an easy storyline to say we would have to have the WHO decide for all of us. I'm completely against
that. This is an example.
Yeah, and I think it's completely wrong, but that's where I think, philosophical question. Let's go back maybe to what we expect from the economy. And we'll go to that wonderful diagram with the cycle. Maybe you could discuss that a bit.
An economic cycle has at least 4 different regions. There are sometimes more, but at least you start by, or you end by the recession. You have the recovery. It can be an early recovery or a more mature recovery. Then you have a period of time where you grow over your capacity and where inflation start increasing. And then you have the response by the government, by the central banks. Liquidity is decreasing. Then you have the slowdown of the economy, and you end up again to recession. Huh? And if we see the current situation, we can see that the emerging markets, and especially China, they had already last year in 2022 and also already in 2021 a very, very weak financial situation and economic situation. And the central banks there started changing the monetary policy. They have provided a lot of liquidity to the market. They reduced the rates. And we have first sign that the economy is responding to this policy and is recovering. Right. On the other side, we have Japan, where we didn't have any restrictive monetary policy in the last years, or also not in the last year. We didn't have any hike in that.
They didn't tighten.
Year. No, they didn't hike. They have also a yield curve control. They want to keep the 10 years yield at a very low level, and they were willing to provide the market with liquidity in order to defend this policy. But now also inflation is starting to increase in Japan.
For the first time since like
very, very long period of time.
Was it 20 years now? Or,
oh yes, it started already in the 90s. We had high inflation rates in Japan mid of the 80s, end of the 80s, and then a very tight monetary policy at the beginning of the 90s. And since then, more or less, since 1995, we have inflation rates around 0 in Japan. But now that has changed. And probably also the monetary policy will have to change. And definitely we have all the other countries in the region of the slowdown or even close to contraction. And that the countries where the central banks decided last year to fight inflation, to increase nominal and real rates. That has impact to the economy, as we saw before in the example of the US. And now the economy has already started to slow down, and probably we will end up by having a situation close to contraction, and then monetary policy will change again, and then we will have the start of the new cycle.
In your view, Tasso, one question I always wonder about, how would this cycle work if central banks and governments would do nothing? There's something to be said for, the natural cycle. And very often you can compare it to wildfires in forests. Once in a while you need a wildfire to clean things up and start anew. And at this point, being hands-off, obviously, would trigger lots of pain because we have so much debt already and we have a situation now. So dampening that debt and having some intervention makes sense. But to what degree, maybe to rephrase the question, if they were a bit more hands-off and less interventionist, if we had something, if we also maybe had some form of limitation back in currencies. I think, going back to Bretton Woods when that was given up, basically a lot of power was given to governments and central banks in terms of creating liquidity and taking it away. Have we gone too far in your view? Is it too much?
We have the experience of the last 15 years, especially after the financial crisis 28, as the central banks had to react to that crisis. And that, if you can remember at the time, that was the threat of depression and of deflation. And they had they had to react on that. They think that was the appropriate policy at the time. But as everything, you have to find the balance. And if you start following an orthodoxy, not orthodoxian policy, monetary policy, because that's needed, you have to correct that at some stage. And we may have missed the best time to do that. But that's life. That's life. And now we are confronted with inflation. We have that problem again, and that's why the central banks, they have to react it. And that creates pain now, no question about that. Probably it will create even more pain than we have now. But that's the price we have to pay in order to find the balance.
So we're heading into that 6 o'clock area of the cycle at this point, at least China kind of leading the way, so they might be a bit quicker out of it all. But emerging markets also headed right into that territory. The US, the EU, the UK, into the contraction zone according to this model. If you had to sum up your expectation of how long this, the trough and the contraction will be, do you expect this to be a longer and deeper period this time, or do you think it could actually pass quite quickly?
A lot depends on the lag we will have of the impact of the monetary policy. It seems now that it will take longer, at least for the US economy, but I think also for the European economy, to slow down sufficiently. Because of the discussion we had about the labor market and excess savings and all those facts. But I mean, even if it takes few quarters more, probably at least in 2024, at some stage of 2024, we will have the new cycle starting. And it's a reality that China is ahead of the Western world, and the emerging markets are ahead of the Western world. But they are ahead because they started hiking rates already in 2021. They were ahead of the restrictive policy also at the time of us. And that's something new compared to the past. And I think that's also part of our new world, that a lot of wealth is being created outside of the Western countries.
That new world, to what degree? I mean, that's where my question comes in to some degree, is the question, if things were normal and if we had a system as it has been established since the Second World War continue the cycle, I would see that there's no question that 2024 will start going into the next boom mode. The question marks I have are around the fact that we really have a recalibration of the world to some degree, and there's also factors, including what you mentioned before, with the geopolitical recalibration of the world. Going into a multipolar world, supply chains adjusting, and the tensions between China and the US growing, which just, I guess, create a situation where downside protection and risk management become extremely important. I mean, if we think about the implications for investors at this point, based on what you're saying, I think investors should be cautious currently. They should also prepare for opportunities ahead. But they should also, retain maybe risk management in place more heavily than maybe in other periods. I don't know if you would agree with that.
I fully agree with that. First of all, even if we expect from a cyclical point of view that probably in 2024 we will have the start of the new cycle, which is positive, there are a lot of risk remaining around this scenario. You mentioned also the geopolitical risks. And if some things happen, then we may change our opinion on the recovery. But aside from that, and aside also from the cyclical perspective, from a structural perspective, probably we will end up by having a world with a lower potential growth and probably a little bit stickier inflation than we used to have. That's a demanding environment for investors, and definitely that's an environment where the real returns will be lower than we had in the past. That means risk policy, as you said, is extremely important.
In your mandates with institutional investors, how will your approach to the strategic allocation change in the context of this new world, if at all?
What we see, first of all, is if you have a portfolio, and this is also the case for the private clients, but especially for the institutional clients, and you manage the portfolio, that's what you need, especially in difficult times when risks are around. You're going to have diversification in the portfolio. That means you look for building blocks and for asset classes where you can be invested, and they may have a low correlation to the real well-known risky assets as equities. Bonds or fixed income used to be a good diversification. It didn't work last year, but probably that year is working better.
Yeah.
But then you start looking for other asset classes. It could be real estate. That is something that we know very well here in Switzerland. The institutional sector is investing heavily in the real estate funds here in Switzerland, or real estate foundations. It could be other parts of the alternative market. It could be infrastructure. In our case, long-short strategies where you try to find
hedge funds.
Alpha, hedge funds, all these kind of things. But what is important is that you define your risk budget and you allocate your risk budget accordingly. And you try to find asset classes or building blocks where you can be invested and where you can be protected if things going to the wrong direction. And that's what we're doing also with our clients. Yeah.
If we look at page 10 or slide 10, there basically, I think it's kind of interesting to see how the interest rate environment has changed. And, obviously we've had for the past 40 years interest rates coming down lower and lower. During that period, financial markets, financial asset classes kind of outperformed tangibles. Do you foresee that now we may go into a period where tangibles could outperform financials?
It can happen, especially if we do believe that inflation will be a little bit stickier than it used to be. And if we also believe, and that's an important assumption we make, that not in the short term, but over the long term, the central banks won't be willing to fight inflation as they are fighting currently.
Why would they not want to do that?
They live also in an environment, the same environment we live, the politicians live. Sometimes you have a little bit more pressure from the public opinion. That's something that can happen. As it happened in the 70s in the US. We have this example. But if you have this kind of environment, and you have a little bit higher inflation, a little bit period of a little bit lower real yields because of the high inflation and not the responsiveness of the central bank, then it's good to have real assets, it's good to have gold in that cases. Then probably the financial assets won't outperform in that way.
You just kind of described at BFI, our kind of most probable scenario is kind of we come to those conclusions, but you have to stay alert and you have to, I think one thing that we also believe is that, it's a bit more difficult to create alpha, or it's a bit more difficult to just make, returns on beta. You have to be a bit more active. which is also a challenge, right?
Yeah.
Because in this market, timing is always difficult. But
Yeah, that's why we find that's a wonderful world for us as asset managers.
Yeah. Yeah.
Because if you have to look for the alpha, not for the beta, as you say,
Yeah.
that's the part of business where we are stronger compared to other competitors.
Yeah.
It's tough, no doubt about that. It's extremely challenging, but it creates a lot of opportunities.
Because of this context, we have quite a bit of gold. We also have a relatively high allocation towards hedge funds.
Mm-hmm.
What's your structure in your typical, let's say, balanced type portfolio? How is your allocation at this point?
Clear, you have to have the equities. Yeah. We do invest in more in fixed income now, and especially when you have time of risks, you must be willing to be invested also on the longer term of the yield curve in order to have as a protection. If you have
depends a bit on which currency, right? For US dollar, it's
yes, depends on the currency. Yeah, indeed, yeah. Currently in the US dollar, you get a lot of return on the short term, huh? Yeah, right. And if you compare this return you get there compared to the earnings yield, it's quite good. But currently, huh? That's the current situation, and indeed, the current situation, you have to
6-month treasury is like, I think 5.2 or so percent.
In the current situation, you have to be cautious on the risk assets, and that's a good alternative. But from a structural point of view, you have to be invested also in the fixed income part. Now you can do that in a much better way than you used to do because you have a higher
We're back
level.
a bit closer to the 90s. TINA is over. Yeah. There's no alternative.
Yeah. And as you said before, you have to be also invested in alternatives. Mm-hmm. We do invest also in real estate, but also in private markets, private debt, private equity. And I think from time to time, especially when you have real yields going down, yes, then you can be invested in gold or even in commodities. Huh? We do invest also in structural thematic funds, in structural changes of the world.
And I think there, again, the fact that beta is over to some degree, simply buy and hold and going up with the market is probably more difficult today. Therefore, you have to achieve more alpha, which in a way you could translate into a situation where the shotgun approach may not work. You need to be more of a sniper, meaning that you kind of have to be much more selective in your sector analysis and maybe thematic analysis. In your mind, what are some of the themes that you are most interested in at this point?
The IT sector, information technology, that has a lot of impact on several parts of the social life. Think about criminality in the cloud. Huh? We discussed
cybersecurity.
At the start. You may use the new opportunities you have in creating smarter cities, as example. Huh? Otherwise, on the other side, you have some lack in some part of our needs. Something what we see that is getting even more precious is water. And finally, I would also say, and that's nothing new, that we all know that currently more wealth is created outside of Europe or the US, in Asia, and you have to be also invested there.
In terms of finding the sectors and the themes, how much consideration do you put into that aspect of supply chains being rearranged?
This is a part, indeed, because that is the question of less globalization, of the regional cooperation.
Yeah, and there's going to be some winners and some losers in that. Yeah.
As always. From a structural point of view, it's indeed important to know how the supply chains work and will be working in order to be invested in the appropriate companies.
One of the sectors that is extremely interesting because of the dynamic changes is the semiconductor area. There, the whole thing with ASML and TSMC, and that's almost like a new it's the new oil, right? Is semiconductors, there's oil, and data. Maybe those are like the three big resources today that need to be considered in all the planning.
And you see also there, the most important places where semiconductors were produced in the world, aside of the US, was South Korea, Taiwan. And now we have the tensions between China and Taiwan. That's a risky environment. And we may see that a part of this business is returning back to the US.
And it is. I mean, they're investing billions to build new plants. Also in Europe, actually, with ASML in Holland and so on. So one of the things I wonder, I mean, we actually at this point, we quite heavily have hedged or protected our downside in stock markets with put options. Do you use that as well?
We do that less in the institutional sector because of the constraints we have there.
Yeah. Because right now that's a situation
where we do that in the collective products, but in the mandates it's more.
To maybe sum things up, so what we've said is, there's next to that monetary policy and fiscal policy area, which is still very important, there's now those geopolitics. And we have I think we've kind of given the prediction that we'll have inflation that is stickier maybe than most expect. Why? Because of tight labor markets. We said there's the fact that we have global supply chains being rearranged. There's lackluster economic growth. So they don't want the hard landing. So that's that balancing act of central banks. One thing we didn't mention or touch on, which is important also, is the fact that and I think you saw the conversation I had with Sune Sorensen, right? And one thing there, which I actually hadn't been aware of prior, is the big elephant in the room: real estate. Real estate as an asset class is like 300 trillion, and if you look at that asset class, I think there's of the 300 trillion, like 258 trillion are residential real estate. And if you compare that, for example, to the equity market, the global equity market, that's like 100 trillion. So a third of the real estate market. So there too, I think what we discussed back then is we need to remember that exposure to real estate, with interest rates, that's holding things back too, because that real estate is a big bucket and it's very highly indebted. There's a lot of mortgage and credit on that bucket. So there too, the public will probably be one where they won't want central banks to increase interest rates too much, which means that inflation will remain sticky for some time.
But it's nothing new on that, because real estate has always been the most important part of the wealth of the private sector.
Right.
And indeed, housing is extremely sensible to the interest rates. We see that currently, not only the US, where we discussed before that the US market is, the US housing market is already in recession, but you see that in Australia, New Zealand, in Canada, and even in Sweden or in Finland, we have an overheated real estate market. And there is the threat of a strong correction. Right. Yes, indeed, there are some, I would say, some constraints that we have because of the strong real estate, or because of the increase of the prices of the real estate market, and that's why also you see that. Also, the Canadian central bank, but especially the Australian central bank, is not able to increase the yields, or to increase the rates as they used to do. Yeah. Because of that, that's a constraint. Yes, indeed.
Yeah, and with the last financial crisis in the back of our mind, the real estate aspect is very present.
This experience, although I think you can't compare the current situation in the US to that prior to 2008. Even if we have now a correction on the prices, and that's needed because we had a huge increase of prices in 2020, start of 2021, we have a different situation that at the time, because now we have much less supply of houses that have been built in the US compared to 2005, 2006, 2007. Right. And also the existing stock is quite old. compared to that we had at the time. That means it's needed to reinvest in that sector at some stages. But now, because of the very high real yields, it's not the appropriate time to do that.
Not
It's
the
not
time,
easy
but
to do
maybe
that.
one of those opportunities looking
That's the
forward.
opportunity of tomorrow,
Yeah,
from a
absolutely.
cyclical point of view. Yeah.
Several asset classes, I think, are opportunities like that. Maybe just going back to the point.
And if we talk about the opportunities of tomorrow from a cyclical point of view, you may have seen that a lot of very strong companies with a very good balance sheet, strong and very high quality of products, the so-called the quality growth companies, they have corrected a lot last year.
Yeah.
Because of the increase of the yields, because they are mostly long duration stocks.
Right.
And a lot of them are here in Switzerland, mid and small
Some
caps.
of them are financially very solid.
Yeah,
Absolutely.
they are very, very
Dividend
solid.
paying
They
stock
have
stocks as well.
corrected a lot. That's the opportunity of tomorrow.
Correct. To maybe just tie what we just discussed to where we are today and with just recent events. We just talked about the financial crisis in 2008, and some of the factors was obviously it was a banking crisis, a financial crisis. Real estate was part of that because of the way those mortgages were packaged back then. We now just heard about Silicon Valley Bank, and then Signature Bank and Credit Suisse also was in the news. The stock dropped 30%. How does that situation compare back to 2008? It's different, but what do you make of that?
I think that's definitely different. At the time, we had a different structure of the balance sheets of the banks at the time, and a huge leverage also in the structure of the balance sheet, and much less transparency.
Yeah. And slower central banks.
And slower central banks at the time. Now. In the meantime, the banks, they have received a lot of capital. They are much better capitalized. We have other regulations. We have more transparency. That's different. But finally, if you have a recession or a deterioration of the economic situation, that has impact also for the banks. Yep. But that's a cyclical deterioration, not a deterioration like we had at the time, a structural deterioration. But even in times where you have a cyclical deterioration, you have always some weak links. And Credit Suisse has been a weak link for a long time, for a long period of time. And every time where you have a tight monetary policy, and the monetary policy is getting even tighter, you have the first cracks on the wall. You have the wall and the first cracks. Yeah. And that's the result of the monetary policy. And that was also in the US the case, because also the correction on the information technology sector was caused by the monetary policy. And also on the correction now in the housing market in several countries is caused by the monetary policy. Then you have this kind of cracks, and banks are between or in the mid of the situation, and they have also a negative impact if things are getting worse. But I wouldn't compare today's situation with that in 2008. At the time, we had much less regulation, much less transparency, much less capital in the balance sheets, much less quality. That's different today.
Nevertheless, I think, we've talked quite a bit about the implications for investors on the investment front, allocations. But I think the other part for investors to really consider is the fact that once those cracks start showing up, that's a time, that's like the 12 o'clock or 5 minutes to 12 o'clock time when you should really look at your custody situation. And where you want to make sure that you work with banks that, on the one hand have a solid balance sheet, but also have a solid business model. And I think that's where banks like Pictet and other private banks that are not exposed, in the realm of investment banking and credit as much, those are the safe havens. Even a bank like Credit Suisse, which will probably be saved if things get really bad, and we now have 50 billion which are being kind of provided as a guarantee. You still, I think, as an investor, you want to work with banks that are not exposed as much to those situations.
Thank you for telling that.
Well, Pictet is not the only, so Pictet is not the only one, but I do think it's important for investors. That's one reason we work with Pictet. There's obviously other private banks as well that...
I mean, that's the way how we do also invest, and how do we think we want to be invested in quality. Mm-hmm. Mm-hmm. And you can find quality in different ways. But quality has a price, but from a long-term view, it's good to be invested in that way.
Yeah, and going back again to that conversation, that was one of the core parts that we discussed back then. Is really it's important that you also look at the facts and the small print in your custodial arrangement. You know, it's not just a brand; it's what's behind is really important.
Indeed.
And So yeah, challenging times. Risk management is important, but also opportunities ahead. Was there anything that you would like to touch on that we didn't touch on right now, or?
I think we had a good discussion.
It was fun
on a lot of things.
Yeah.
Let me end by telling you and us that we have been in business for a long period of time. Right. It's in my case already 3 decades, so probably in your case even more than that. We have seen a lot of things. The environment may have changed somewhat, but the positive and the optimistic point is that we have a young generation, people, our children, that have learned a lot. They have received our capital stock, and they can develop this capital stock in creating an even better world than the world we have been living.
I love that because that's something when I explain that to our kids is what is capitalism. Capitalism is not just about money and investing or taking risks and starting businesses. It's the capital that already exists and the values and the possibilities that have been created by generations before that you can then build up on. And I think that's where the opportunity lies. So let's be optimistic. We'll get through this trough and cycle. and then hopefully for our children there will be better opportunities ahead. So it's not all dire and dark. Tasso, thank you so much. This was great. I really enjoyed this.
Thank you, Frank, for having me.
Let's do this again sometime, and hopefully then we'll be back on the upside.
Okay, thanks a lot.
Thank you so much.